Every expert has a path, a journey, but they have to start somewhere, right? And I can say for certain that my start in my path to getting to hard money was anything but the norm. In fact, it started in the financial crisis, 2010. The CEO of my old company called me into his office and said, Mike, I want you to go out to California and buy 1,000 houses. They're all gonna need renovation because they're bank loans, but I want you to go out and buy them. I want you to go renovate them. We can hold them, but ultimately we're gonna hold a lot of them and we're gonna start with this package here. My name is Mike Chadwick and I've been in the hard money space for over a decade. In this video, I'm going to get into my background as to how I got here. Like a lot of people, it started in the fix and flip space, but not a lot of people started with the high volume expectations that I did. With ultimately the goal when I started to get up to 2,500 houses. Here goes.
So a hard money loan is really just a bridge loan. It's really just a bridge loan from a private lender, an unregulated lender. So what are the benefits of hard money loans? Why do investors, first-time flippers, all the way to investors with thousands of units? So I've closed over $1 billion in hard money loans, and I can assure you one thing, not every project qualifies for hard money.
Well, I'm sure you're wondering, Mike, how did you get to the point where the CEO of a $2 billion company is asking you to go out and buy 1,000 homes? And I guess we should start at the beginning. I was in college, playing college baseball with every intention of playing professional baseball. From there, I parlayed that into an entry-level job, working as an underwriter and analyst for one of the top producing multifamily Fannie Freddie originators in the country. We were doing deals with the likes of EQR, Archstone Smith, doing $200 to $300 million loans, and it was exciting. I got to learn all about underwriting apartments. I got to learn about how cash flow, DCF analysis, and everything that goes into investing in cash flowing real estate in general in different markets across the country, and the dynamics of understanding employment drivers and the economies surrounding these properties and the markets, the submarkets that goes into the analysis of multifamily properties. It was really a great foundation for learning real estate, commercial real estate. It was just a really great experience. And from there, I went to work as an investment banker with Bank of America in their mezz and participating debt division called Tri-Sale. It was a legacy fleet program where we were lending mezz and participating debt behind very large senior Bank of America loans. And it was really exciting. It was high yield debt, yields between 14 and 19%, paying accrue structures that were really complicated. We might have a $20 million mezz loan behind a $100 million first mortgage to fund the construction of condos in New York. It was an exciting time. I used my experience in underwriting multifamily to do a lot of condo work, to do a lot of apartment work, to continue, as I say, to expand the capital stack, to go from first mortgage lending to mezz underwriting to equity / participating debt, and to cover the capital stack. It was really exciting. And that first decade, I would say, of my experience was the foundation that led me to join a company based out of Rhode Island. So $2 billion, very opportunistic, family-owned business who I loved to work with. It was a great family. And the CEO was super opportunistic. And I came to this company managing their $1.7 billion debt portfolio. We had loans with the likes of Wachovia, JP Morgan, Wells, all the top banks, including several other avenues for financing. And, I joined this company right in the depths of the financial crisis. It was 2007 and I was thrown into the fire. We were financing at the time about $1 billion between big national bank and a regional bank for the acquisition of about, a dozen hotels. And as we were financing those and closing out a fund with a large pension fund, the market was crumbling beneath us. We were seeing all this opportunity play out where we were having the ability to buy debt at pennies on the dollar. And everything you read about was real. The opportunities were amazing. And really one of the biggest sectors that took a real pounding was the housing sector. And at that time, let's say 2010, 2011, the stock market was at its all-time low in 2010. I mean, housing, which took a very long time to go from its peak value to what I would say its trough, which in the markets that I was covering might have been, late 2011, 12 even, from an 05, 06 peak. There were massive opportunities to buy homes if you were liquid. And it was becoming really obvious to everyone around that it might be the time to be greedy when others are fearful. And that was the mantra of my CEO. I mean, he's a Warren Buffett follower. We were in a room with some really smart, impressive people with 40-year careers in real estate, talking about how scary it was potentially to go out and buy homes. And there was my CEO with a package on his desk, adamant to move forward. And, I, again, had that background in underwriting apartments. We had already gone out and started to acquire apartments opportunistically. I had acquired an apartment community down in Dallas that was 400 units, and we were moving towards growing our multifamily book or portfolio. And so TPG Residential was emerging through the acquisition of these apartment communities. And now what was emerging as a potential add-on to the strategy was the ability to go and buy and renovate and ultimately rent at a really attractive yield, single family homes. So while I went out and started to do due diligence on multiple packages, including this 1,000 home California package, there were several other packages that became available. And ultimately what was decided was that I was going to go out and try to do this in our backyard, which in this case was New England. And I thought it was really going to be difficult to own and operate scattered site residential property on the opposite coast. Obviously, acquiring and managing is one thing, but overseeing the renovation and repositioning and then the potential of renting these units was a whole nother one. And so what I proposed was that we expand our residential platform. We go out and we raise $10 million and we go out and we buy houses in our backyard. And through that, we built out what was a residential division of the company. That residential division was out buying apartments and single family homes. Ultimately, spawned out of that was a brokerage division. And then finally, the end of the story is a lending company emerged. And so, we started out with the idea that we were going to grow to 2,500 houses, and with deep pockets, we went out and competed. We started in Rhode Island and we bought, 20 or 30 houses in a matter of about 4 months. We had a palette, an interior designer helped me design what was going to be the standard, let's call it color palette design characteristics of every house that we went into. Certain houses required full renovations. We had a full setup for a full reno. We had bathrooms, vanities, tiles, all of the colors, the matching showers, everything laid out perfectly and templated so that when we went into the first, say, dozen houses, we were creating a template by which we were going to use to scale. At that point, I had acquired enough where I started to bring in a local broker that was able to establish a presence for me in the brokerage side of the business. So the broker represents me on the buy side to go out and buy these houses. As a result of our acquisitions, we're building up a brokerage business and its presence in Rhode Island. We took that after, I want to say, 30 to 40 houses, and we moved it into Connecticut, into Massachusetts, and we kept buying. We formed brokerage offices around the portfolio that we were, or the houses that we were buying from the banks, and we were scaling. And right as I want to say we were about 100 houses in, I went to the board, to the investors, and I said, listen, I'm out competing day in and day out, buying properties with a $10 million wallet. And we were acquiring properties 10 a month. I think our most was around 20 in a month. And we were renovating all of these. So they were going through a process that was really well defined. And we had fee businesses surrounding all of the processes, which was, in my mind, a unique thing about the structure that we had. And ultimately, what we were doing in competing with these, what I would call mom and pop investors, is we were standing there and we were making offers. And no matter how much cash we had, it really didn't matter. Cash was all the seller, which in most cases was the bank, wanted to see. Or they were equally as comfortable closing with a hard money lender behind said mom and pop investor. And as I was going out and my guys in 3 states were out trying to make as many as 20, 30 offers in a week, we were losing out on deals and to investors that were backed by hard money. Here we were, an institutional investor with the deepest pockets, putting offers in place, and we were losing out on bids, and it was preventing us really from getting the scale that the investors were looking for. And then that's the time when I decided, listen, if we're gonna get this scale, if you're gonna want a company to build in assets, a portfolio that's going to justify your existence in the space, we're gonna need to do it through lending, and we're gonna need, and the board, the investors loved the idea. I had never made a hard money loan in my life. Certainly I had a backdrop in lending because I have underwritten loan, but I had never sold a loan. And there I was, no word of a lie, a week later with more money than I knew what to do with in terms of lending. It was to package up all of that and to deliver that to a lending platform that gave the investors comfort of knowing that I was underwriting, that I was deploying their capital with a mind on credit quality, on the quality of the asset, and to leverage that and to ultimately grow and to really hit the market and fill a void that was so clear to me. There was tons of opportunity. No one buyer could accumulate single family homes the way that we wanted to in New England. But in our market, it was really difficult. And the only way I felt that I could get scale in the space was to do it through the lending platform. And I brought in the capital to the space through the $3 billion or the $2 billion company. And we took it from, $3 million in lending to $5 million to $10 million. We kept lending and we went from a small portfolio of loans and maybe a $10 million balance sheet to one that was backed by now a regional bank. And that allowed us to go to 30 to ultimately 60 million. We started lending in now not 3 states. We started lending in a bunch of states and growing. And ultimately back in 2019, we became backed by Goldman Sachs. And it was one of my top, career highlights for sure, to have built a company that went from zero to the potential of lending 100 million or more with one of the most respected institutions on Wall Street. It was just something that I could have never imagined. And it was something that was exciting, and it was happening at a time when the world was changing. And we'll get a little bit into that in the next part. So one of the more interesting things about me that I think is unique, ironically, something I share with a lot of people that I work with at asset-based lending, is that I was a college baseball player. I went to college at the University of Rhode Island my freshman year, Division I baseball. I was a pitcher. I transferred out, kept 4 years of eligibility, and went to a school called Eastern Connecticut, which was on par, if not better, than most of the top Division I baseball programs in New England at the time. I think my closer was drafted in the 3rd round and was throwing 98 miles an hour in the Nationals. In fact, my freshman year, we won the national championship. I had 2 wins in the Nationals, which I think was a first as a freshman. Won all New England and ultimately became, scouted by the Red Sox, the Pirates. But my arm was deteriorating, and I became more enamored by business, by the capital markets, the financial markets, the classes that I was taking. And after 3 years of playing baseball in college, I gave up my last year of eligibility because I got an opportunity to do an internship at an investment banking firm called Solomon Smith Barney. And that changed everything for me. It gave me the opportunity to come out of school and get right into underwriting institutional multifamily properties across the country. I learned all different markets coming out of school and working for one of the top producing originators of multifamily loans in the country. We were doing $100, $200 million deals with the likes of Equity Residential, Archstone Smith, and you name it. And so while I came into college thinking, man, I wanted to play professional baseball, I actually had an extra year of eligibility, which really was a shocker, I think, to a lot of people, that I would give up a year to do what I did. But it was the best thing I ever did. It got me into real estate. It got me into underwriting. It got me into the analytical work I needed to do to build the foundation that ultimately led me to being able to underwrite probably over 1,000 hard money loans now at this point. So now that I had the foundation of underwriting multifamily and income properties under my belt, I parlayed that into a gig with Bank of America and their investment banking group, underwriting, structuring high yield subordinate debt on you name it. I looked at flex industrial properties. I financed high-rise condominium projects on the Upper East Side, projects with $10, $20 million unit sellouts. The condo projects that I financed in New York City was absurd. We did a lot in Miami. We financed hotels in Houston. You name it. I got to see all the different property types, but I got to see how the senior debt was being structured and ultimately layer high-risk debt behind it with rates in the 14 to 20% range with all different types of structures, pay and accrue, you name it. It was really a great education, and it got me as close to the equity side of the table, let's call it, of the capital stack, as as possible. And ultimately, that was really my goal. I wanted to go work for an owner-operator where I could be on the acquisition side, the development side. And that's where I was heading next. So after several years on the debt side, I really was anxious to get on the ownership side of the table when it comes to real estate. I don't think there's any better foundation than learning real estate through underwriting loans. It to me is the best education. I wouldn't have changed anything about that part, the beginning part of my career. And yet at the same time, I was anxious to take more risk. I believed I had a great foundation for understanding markets, understanding how operators performed. And I was ready to take that and take it to the ownership side. And that led me to a job with a $3 billion company based out of Rhode Island. My job was to run their debt portfolio, which was about $1.7 billion at the time. And then also get my hands some acquisition work, some development work, and start to do some different projects that the company always had their roots in, but that they had just gotten too big really to keep doing, given that they were operating, Marriott's, Hilton's, you name it. And that's what I joined. I joined at a really interesting time because I joined in 2007, which was basically the start of the financial crisis. And that was in itself an amazing education because I got to deal with a lot of workout scenarios. I got to look at probably $1 billion in distressed debt. I ultimately ended up getting my hands into building a full-on residential division of the company. And in 2010, we went out and bought 400 apartment units in Dallas. And that was the start of it. The company started to show more and more of a desire to diversify away from hospitality and had their roots for really generations in residential housing. As the market started to soften, which, call it 05, 06, depending on where the market is, it started to become more and more interesting for my CEO, whom I loved working with, because he really shared a lot of the same principles that a Warren Buffett, does, which is you want to be greedy when others are fearful. And in 2010, started talking about the housing market. He called me into his office, dropped a package of 1,000 homes on my desk. The package of homes was out in California. In comes the chief legal, the CFO, the COO, and now we're discussing going out and buying 2,500 houses across the country. And ultimately, I was like, whoa. If we're gonna buy, renovate, rent, ultimately sell homes on steroids, we probably should not do it on the West Coast, and we should probably do it in our backyard. And that's when I started to build out the framework for TPG Residential, which was going to be a combination of multifamily housing units, which we had already started building, hopefully what was to be 1,000 to 2,500 homes. And we started building out a portfolio of bank-owned homes in Rhode Island in our backyard. I think we got to about 25 in about 3 months. We built the template out for how we were going to renovate these houses. I had a designer that I was working with that set the template, design, colors, the materials, the cabinetry, the vanities, the tile, everything, to set out a template for each and every house that we move forward with, and for whatever the house might need. If it needed next year paint, this is the color we're going to use. If you needed a roof, this is the shingle we were going to use. And we laid it out to scale. And then I went out and hired people in 3 states who were brokers in themselves to go out and help me acquire more houses. And we did it up until about 100 houses. I mean, we had to go ahead and buy them, renovate them. We rented them, and then we managed them until such time as we decided to sell them into the marketplace. But that structure, I felt, was unique in the sense that we were building out a portfolio of homes. I had 10 to 15 million at my disposal to go out and buy these homes. And then we were going to renovate them. And in my mind, I wanted to have built out an organization that could see that project from start to finish, to see it all the way through. I ended up hiring in each state licensed brokers to be acquisitions associates, to manage the renovations, to ultimately lease these properties and position them to be sold in the end. So these hires that I made, they weren't just, let's call it local investors. These were licensed brokers who could build an office. I could build an office around on the brokerage side. Spawned out of TPG Residential, or the residential division, was a full-blown brokerage business that's still operating today. So we had a pile of capital and a goal to go out and buy a couple thousand houses. We put people in place. We put a template in place to renovate. And ultimately we set out and we were cranking, and we got to about 100 homes. I want to say 125 homes. And at that point, we had lost so many houses to bids made by mom and pop investors that I went back to the board and said, listen, I think we're in the wrong space. We're too big to buy 5 or 6 or 10 houses at a time, and I can't acquire enough houses. I think the most we were able to acquire was 20 houses a month. But you still have to renovate those houses, so you still have to bring them through the process of renovation before they can get into the queue to be rented and stabilized. And obviously, that takes a lot of work and a lot of manpower. And we had the people in place, but you can only go so fast and you really can't build and scale if there's not enough opportunity to buy the inventory, right? We're competing with these mom and pops. So what do I have to do? In my mind, I have to turn around and lend to those mom and pop investors. I have to deploy capital to those investors to get the scale I need ultimately to be of enough size within the company that I was working for to make this whole effort worth it. And we turned around, I put a business model together. It started out as a company called Emerald Capital. I quickly pulled together $3 million with the family's funds and investors. We went out and I made hard money loans. I had never made a hard money loan in my life. And yet I knew it was happening around me and I knew where I needed to go. But more importantly than anything, I knew what it was going to be like if I took a property back, because I said to myself, like, who better than to lend on a fix and flip than me, who was in position, ready to just add another fix and flip to the 50 others properties that I was renovating at the time. Couple that with the fact that I was also overseeing a development on the coast of Rhode Island that included, 16 very complex coastal, like seaside, and all the regulations that go with it, a development. It was a gated development, it broke sales records, but when you throw that in the mix, it's a lot. And you try to figure out a way to deploy into the market all that expertise to backstop what ultimately would be a lending platform that will lend on fix and flips, ground up construction. And that's what we set out to do. Emerald Capital ended up starting out with a few $1 million. We quickly went to 10. We were backed by a local credit union. And then before I knew it, we were on our way to 30 million backed by a regional bank. In 2019, I closed a facility with Goldman Sachs for 100 million. I had several people working for me as LOs. We had a couple offices. And as much as I love the company and the family that I worked for, hospitality was their number one business line. And everybody knows what happened during COVID. It was a unique time for hospitality. The family that I worked for, they were so great to me to give me the opportunities to do what I did. Now was the time to learn a different view on the business. The business of hard money lending was emerging. I saw the opportunity to scale my time, to grow, and to become more part of more of a lead gen perspective than purely like a word of mouth referral, to get really more deep into the marketing side of it. And there was no better company to join than asset-based lending. ABL was number one in the search results everywhere. Asset-based lending to some is synonymous with what we do. ABL had the capital to grow. And in 2020, I joined asset-based lending. And over the last few years, we've grown from, I think, 0 loans in, let's call it Mass, New Hampshire, Maine, Rhode Island to doing, upwards of nearly 100 million a year, and building out a great community of investors around me. Asset-based lending has allowed me to scale. My old company, gave me every opportunity to learn the business and build it out and learn in the trenches while going through fix and flips in volume and trying to scale. It was really a unique opportunity, and one that is, looking back, I just can't thank the family enough. But it springboarded me over to ABL, and it's giving me a different perspective on the business. It's one that is so great to see. I think hard money lending has operated in the shadows for so long, up until I want to say the financial crisis. It used to be, I know a guy who knows somebody that lends, a small local shop, lawyers, doctors, dentists pooling their money together, to what I feel like has become an industry that has filled a huge void. It's an industry really more private lending than it is hard money, but it's filling a huge void in the marketplace for investors who need speed, who don't want to deal with the bank's red tape and all the regulations. They want and are absolutely thrilled to go through a process that's efficient, that to me is more along the lines of what hard money should be, which is the purest form of lending. I like to joke that hard money is really the oldest form of lending, and it's been around as long as gambling and prostitution. It's one of my favorite quotes, but it really, for me, it's been something to kind of see this industry really come from this shadow banking world to what it is today, where you have these companies that are able to securitize hundreds of millions of dollars of loans. We're able to put rates in front of investors as a result in the single digits. And when I was starting in hard money, the first loan I did was at 55% loan to value at 12% in 4 points. And it had a 12-month term. Ever since, I've been following the market ever so closely and seeing different executions happen in the marketplace and investors grow and scale their business through using hard money, which is super exciting for me. And it's been an unbelievable thing to watch as the community of borrowers around me builds. And so, I've had the opportunity to kind of take it from the ownership side to the debt side and back. I'm always interested in other folks' story. I encourage folks to comment and obviously like and subscribe as well. But leave me your story in the comments. Tell me what you did to get into the hard money space. Tell me what you're trying to do to get into the hard money space. And I can probably guarantee you that not many people were given $10 million and were told to go buy homes and flip them, and then, had that foundation like I did. A lot of folks, start with friends and family money and start flipping that way and then learn the space. Others are residential consumer lenders that see the opportunity to join the likes of an ABL because they see how exciting it is to work with builders, developers. No matter what way you got into the space, share your story. I love to hear it. Hard money is a stigmatized term. It's private lending, it's pure lending. And I'm really excited to give a diversified set of both long-term and short-term programs to my clients that I can execute on and close within days at times. And to me, the ability to facilitate transactions to allow my clients to scale is everything. I'm here to help you succeed in real estate. I want you to use my experience, whether it be following me on this channel or calling me and inquiring about our programs here at Asset-Based Lending. One way or the other, my job is to allow you to benefit from all of my experience, whether it be flipping as a first timer or to a fix and flipper that wants to scale, or just somebody who's interested in learning how to fix and flip. We're going to cover that on our channel. We're going to cover how to go about using hard money to scale your business, to be able to use your capital efficiently. We'll cover all that, but definitely, please, don't hesitate to ask questions. Tell me your story. Tell me how you got into hard money or how you got interested in hard money. Leave it in the comments. Again, thanks to ABL for sponsoring the video, and I look forward to the next one.